this PowerPoint. I'll find a way to get it to David and he could email it to you. Or if you want to come to our website, contact one of our members here and we'll get this to you. So you'll have something to walk away with. Now, by a show of hands in the chat box, just by putting a Y, not, you don't have to put raise hands and get all complicated with that because I like to keep things super simple. With a Y, how many of you have been trading for less than 2 years? Less than 2 years with a Y. Okay, Eric, Ann, Ray, okay, Patriot, Lax, 01. All right, I'm a big Lax person there. All right, less than 2 years. And Ray, you're less than 2 years. Okay, now I have a lot to offer here, and the reason I asked that question is so I know who we're working with, because there's going to be a lot here for the brand new or novice traders, and there's going to be a lot as well for the intermediate traders and advanced traders. Just to kind of back things up a bit, I've spent 42 years in the markets. I started in August 15th of 1982, and I cut my teeth in the commodities markets trading gold and silver. Made a lot of mistakes, made a lot of money, lost a lot of money, and then made a lot of money back. It's like a rags to riches story. And what happened is those lessons that I've learned were something that I took with me through the rest of my career. And it all has to do with emotions, folks. I can't think of a better topic to talk about, especially in these volatile markets, than emotions and how to control them. Now, just so you know, to set this up, towards the end, I'm going to take live stock symbols from you, and I'm going to bring up live charts so that we can apply some of the things that I'm talking about to help you remain more profitable. One other little tidbit is that we have an algorithm that tracks all of my price targets. This has been going on for almost 3 years. Adrian, who's the programmer, is working with us. And while I was out there in the world putting price targets out on these stocks, Adrian was secretly tracking my scorecard. And as we find out now, over a 3-year period, 83% of the price targets that I establish on stocks, 83% of them hit their targets within 66 trading days. That's about 3 months now. So this is not for day traders, but there's no one in the world, at least to my knowledge right now, who has an 83% hit rate on targets. Now, my goal here tonight is to show you enough to get at least 70%. This is not returns, by the way. I'm not making any returns or guarantees or anything like that, but I'm telling each and every one of you, even if you have 2 years or less in the market, if you practice the simple concepts that I'm going to show you here today, you should get at least 70% hit rate on your targets. Now, even with a 70% hit rate, you could still lose a lot of money, especially if you let the emotions get a hold of you. Because how many trades, let me see in the chat box, I want to keep this interactive and alive. How many trades does it take to blow up your account? Let's see, who's the first one to answer that? All right, we got, exactly, David, it only takes one. Look at Ray, by a nose, second, Tim, third, and by a long length, we have Eric. Okay, yeah, it only takes one bad trade to screw up your whole account and possibly your financial life. And so if you manage the risk, which is again what I'm going to get into here, you'll be able to keep that all under control and actually have fun in the market without stressing out over, we have bad news today on the unemployment. Well, as it's turning out, the new norm is bad news in the economy is good news for the market. How many of you heard that already? It's not making any sense, but the charts don't have an opinion. They don't have emotions. They don't have anything that's going to get in the way of just actually reporting price history. So risk management and what I'm going to apply in what I call the 1% rule is going to help you move away from the emotions and into an area of discipline. And if you could stick to a plan that allows for that discipline and you stick to it, it's going to help your life remain a lot easier in far as keeping things super simple. I'm not going to sit here, by the way, and read every line on every bullet point that I have here. This is for your reference. I'm going to talk off of these points. And then again, if you want the PowerPoint, just let us know and we'll send that to you. One of the most important things, if you could see at the very bottom here, risk management is non-negotiable. What does that mean? It means that if you put a sell stop, if you go long a stock and you put a sell stop below a technical support level and the stock starts breaking down below the technical support level, but yet it's still a couple of pennies over your stop loss order, you don't want to renegotiate and say, well, let me see what Jim Cramer has to say about this. Or let me see what the talking heads have to say on CNBC about this. And then before you know it, you're looking at fundamental data that has nothing to do with the technicals, and you're talking yourself out of that discipline for managing risk, and you're talking yourself into, into holding on to a loser that's getting ready to bite your head off. You see, so I'm a floor trader. I've been doing this for a long time. As you know, I just mentioned that. But my passion, it's an absolute passion. Ask anyone who knows me long enough. They'll tell you I absolutely love teaching people how to do this. Because when done correctly, you can make a lot of money. And my goal is not just to help you pay the bills and take care of your family, but if I do my job right and I can help you stick with this discipline and make money, my wish after that is that you take that money, or some of it at least, and go out there in the world and do good things with it. We have one member of ours, his name is Roby. I don't even know if Roby's on here. Roby, if you're in there, shout out on the chat. Roby has been doing so well with his trading that he's giving a lot of his profits to St. Jude's Hospital for kids that are suffering with cancer. So that's what I'm talking about. Taking your profits from the market and turning into a hero, right? Turn yourself into a hero and give back and do good things with the money. And when you start doing that with your money, guess what? The discipline becomes easier. You might think, well, how is that possible? Because if you are now setting a stop and you're making sure it's non-negotiable, now you're going to say, you know what? I can't let that stock go against me, because if I do, I'm going to lose the profits, or I'm going to suffer losses here, and I won't be able to give to St. Jude's Hospital next month. You see, it helps you more or less stay accountable to your own actions. All right. So now I'm going to show you this. Having the plan, I just mentioned that, having a plan. I'm going to go through these very quickly because I want to get to the live charts. Having a plan helps you stay accountable because you're not going to veer off the plan. In the chat box, how many pilots do we have out here in the chat with a Y? Any pilots? I don't know. Do we have it with a Y? Any pilots? I know there's a little bit of a delay there. Okay. I don't see any pilots on there. Well, pilots, if there are any navigator, okay, David's a navigator. Well, if before you take off the ground, you got to have a checklist, right? That makes sense. You got to have a flight plan. In case you go off course, someone can help find you, right? I have a trading checklist that I use, and I'll show you, that helps you follow the signals one at a time. I don't have anything here that's complicated. I'm not going to show you fancy formulas. I'm not going to show you anything that's going to make you confused. It's a simple checklist. And when you look at candle charts, the charts will give you the signals that you need to make the decisions. All right. Now, here's another part about risk management. If you follow my 1% rule, which I will get into the simple calculation of putting out there for yourself, if you are following that 1% rule, basically in one sentence, what you're doing is you're only allowing, I know it sounds crazy that you're allowing the market to take money from you, but you are allowing yourself to be wrong. And when, not if, you are wrong, you're only giving the market a very small amount. What this does is it allows you to be wrong more times. Now, this is very hard to understand for those who are really success-minded, because no one wants to be wrong. But the fact is, we're human, we do err, and when we do, we have to make sure that we own up to it, and we limit the loss so that we don't punish ourselves by holding on to these losers that continue to punish us. I mean, I don't know how many of you got out there and saw some of the stocks out there. Anyone see what happened with Roblox today? Stock came out with earnings, boy, they got punished, but the chart said to get out 2 days ago. right? People that weren't following the charts are suffering a big loss. Even if they had a stop in there, the gap was so far down that they wound up losing a heck of a lot more than they originally planned to do in the first place. So the keeping the losses small by using the 1% rule doesn't mean you have to keep tight stops or sell stops right below the price action of the stock. You could give the stock enough room to breathe, and this is more trading technique than anything else, so that you can allow the market to have that volatility and still be able to stay with the stock, at the same time minimizing the loss to small amounts. This is a 6-step process here. Remember, I want to keep it super simple. You first identify the market that you want to participate in and the segment trends. Some of you like to trade tech stocks. Some of you are into AI, just trading a handful of AI stocks. Some of you are into pharmaceuticals, whatever it may be. You have to let the charts tell you which way the trends are going. And then more or less what you're doing is you're identifying the stocks within the trends, and you're putting your money in the direction of where the money is flowing, right? Follow the money. Have you heard that term before? Follow the money. If you're following the money, then you're buying with the buyers and you're selling with the sellers, instead of those who are going to go out there and look at stocks that have recently got punished, like Starbucks, for instance, and just on the first day jumping in because, oh, it's got to bounce from here. That's an opinion. That's not based by any kind of signal. It's a pure opinion. So if you allow the charts to talk to you, and they will once you learn the signals, then it makes it a lot easier for you to make those decisions. Once you've found support or resistance, depending on where you're placing your order, if you're going on the buy side or sell side, you have to then identify where your entry price is, and then you have to identify where your stop price is even before you get into the stock. Hopefully that makes sense, because the worst thing you could do is just jump in on an emotional charge for whatever reason. Maybe it's a headline or a Fed announcement. You just got to get in there and then try to figure out where you're going to put your stop. You have to do that. You have to set your stop level even before you hit the enter button to place your order. And again, if you do this properly in the steps that I'm showing you here, it makes it very calculated and more or less routine. Once you get into that routine, it becomes more mechanical over time. You just heard Jake talk about the seasonality of stocks. Well, a variation of that, and something that I look at, is cycles. That's part of my plan, right? Remember when I showed you to put the plan together as part of risk management. One of my favorite plays, and a lot of our members who might even be on with us right now, is Hershey, ticker symbol HSY. Every week before Halloween, we tend to get in on a long position. Why? It's a seasonal stock. It's very cyclical. Hershey stock tends to go up right before Halloween and during Halloween and right through until February, Valentine's Day. And then we start to sell it. So it's a window that we generally play on the equity side. And in some instances, we put option plays on that. Now, we're a long way off from October right now, but put that on your calendar to start looking at Hershey right before Halloween. And then go back on your charts, and don't take my word for this. You could, but don't. Go and look at the charts to see what's happened with the stock every October and right through February, and you'll see the cycle of that. Now, I use the Thinkorswim platform, and so if any of you use that platform and you would like my layout exactly the way it is and actually how you will see it, you could again send an email to AJ members at Sticky Trades. I'll say that again later on, but if you send an email to ajmembers at stickytrades.com, I'll send you my layout if you have a Thinkorswim platform, and then all you have to do is click on the link. It'll open up my layout, and then you could save my layout to your platform. It'll be exactly as you see it here today. Now, I'm not going to take questions just yet, but be ready if you have any questions, because I'm going to take them towards the end. All right, now, the 1% rule. Let's slow it down just a little bit. It's a simple calculation that, if I were to put this in a sentence, basically is you stating to yourself. So you say, you raise your hand, you raise your right hand, say, I, and then state your name, give myself my word that I am not going to allow the market to take 1% value of my account from me. I'm not going to let it take more than 1%. No, I'm not going to do that. You might say, well, how is that possible? Well, if you follow the formula, it's very easy to do that. Now, the whole concept is allowing the market to go against you, but figuring out how many shares you're able to buy based on your stop, so that if you are stopped out or if your stop loss order is triggered, the max amount you should lose, if you do this calculation correctly, is 1% value of your account. That's it. Now, I'm using $100,000 as an example. Some of you have 10,000, some have 50, maybe some of you have 5, maybe less. I don't know. Whatever that number is of your account value, the first step is to calculate 1% value of that. And in this example, with a $100,000 account, $1,000 is 1% of my account. That's known as the risk amount, right? That's the most I want to lose on any given trade. This is not on all of your trades. I'm talking that this is applied to each one of the trades that you put in. Now think about this. If you're right 70% of the time, and that's my goal for you, is to become a hit master, right? You want to get at least 7 out of your 10 targets to hit. If you get that percentage using the trading checklist that I'm going to show you here, if you get that percentage, that means you're going to get stopped out on 3 stocks. So on those 3 stocks, 1%, 1%, 1%, out of 10, the most you should lose is 3%. But remember, you have 7 stocks that are working in your favor. And that makes up the difference of the loss. You see, so mathematically, if you do this and you remain consistent in your technical analysis, then you have a winning formula right there that you can live with and relax with and even have fun with, right? And believe me, having a formula like this with a plan, boy, I can't even tell you how much stress that takes off your shoulders, because you're not winging it or hoping, right? Hope is not a strategy. You may have heard that before. It's not a strategy. It's an emotion, right? You're hoping, you're wishing. Sometimes you're praying, right? Oh, please let Starbucks go up to my break-even point. Then I promise God, I'll be good for the rest of my life and I'll get out of break-even. Well, we're not in this game here to pursue break-even. We're in this to make money, up, down, and sideways. Now, I'm not going to talk about options. I'm an option trader, and a lot of our members are option traders. You'll have to take that on another seminar. But if you stick to the system, it'll work. So step 1, remember, I'm repeating here, but I teach you repetition. Step 1, calculate what the risk amount is. That's 1% value of your account. Step 2, you now have to calculate where your stop is going to be. Now, I'm gonna throw a curveball in here real quick. Someone, first one to put in a symbol right there, type in a symbol in the chat and I'll pick it up on my chart. First one, who wants to be, HD, Home Depot. All right, now I'm gonna stop sharing. I'm gonna share my whole screen right now. All right, let me see. Can you see my charts here now? I'm gonna put in, is that David? All right, so I'm gonna put in HD. Let's say that you wanna go long Home Depot right here. You wanna go long Home Depot. You see a candle, you see a pivot, you see it bouncing off the moving average. You have to calculate where the support level is. I see a couple of levels here. I see this support level being a gap fill level, gap fill support. Then we see a support level all the way down here, right around 330, right? So now this might seem crazy, but it's a high price stock. What I do is I'm going to put my stop somewhere below support. Let's say I put it in at 327. I buy it at 347. I put my stop at 327. What's my risk per share? 20, right? So now I take the 20, that's my risk per share, divide that into my risk amount. That tells me how many shares I get to buy. Now, if you're trading Home Depot with any significance, you're going to have a bigger account. If you don't have a lot of money in that account, then trade a stock that's cheaper, right? Who has another stock? That's XLE. Let's go to race stock. That's going to still be pretty high, but let's go look at XLE. XLE, here you have an ETF. It's an energy ETF. Let me get rid of my little drawings there. That stock is priced a little bit less than Home Depot. Here you have a pivot, but it's not just any pivot. This is where you got to learn a little technical analysis. If you follow along with me, you'll know that I am a big fan of roll reversal. What is that? Here's a former resistance area up here. See resistance and then resistance. If I drag that all the way across, what happens? Resistance was broken here, and now it reverts back and flips to support. So if I'm looking to buy this stock at $94 and change, I'm going to put my stop below 92. Let's say I put it in at 91 and change. Now my risk per share is $3. I take that $3 and divide it into what? Who wants to answer that? What am I dividing the $3 into? Step one, hint. I divide that, there you go, into the $1,000 or my risk amount. So now I get to buy roughly 300 shares of the stock. It's a cheaper stock, so I could play with that. Now, some of you are saying, man, it's not enough profit for me. That's not, I want a home run. I want to get a 10Xer out there. Give me some penny stock to trade that I could buy at $1.50 and let it go to 15. Well, if that's what you're pursuing, I got to tell you, this isn't the stop you should be at. I'm talking about longevity. I'm talking about consistency. I'm talking about trading for some of you for a living, right? We have traders, professional traders at Sticky Trade that have trading rooms, and they trade live in front of our members. Greg Montwell, for instance, he has his trading room during the week. Greg's been trading for over 40 years like me. And all he does is he shows everyone his trades, and everyone looks at his trades and he explains it, just like I'm explaining it to you right here. There's the roll reversal. This is almost like a cup and handle pattern. I don't want to go down that road because I could get off on a tangent on technical patterns. But that one looks like a pretty decent trade the way it stands right now, even as a short term. All right, look at the oscillators down below. Part of your plan, by the way, should include oscillators that are being put on your charts that you follow. My two favorites are the stochastics oscillator down here. You see that? The stochastic and the CCI. There you go. The CCI is absolutely by far my favorite. It was created by Don Lambert back in the 80s. If you're not using it already, put the CCI, the Commodity Channel Index, on your charts. You're going to be amazed. Now, what's happening here, again, it's hard for me not to talk about this because there's just so much action going on in this one right now. I'm bullish on energy, by the way. Some of you already know that, have been following me. But that blue line right there, that's the actual CCI. You see the black line at the bottom right there? That's the zero line of the momentum line. Now, when the momentum line is crossed, like we saw back here, see how the momentum line crossed? Generally, you get 2 to 4 days of upward price action. Now, that is also contingent upon the CCI going oversold first. All right, so if it goes oversold, then starts to move up and then crosses over the zero line, you have a very high probability of a move higher going from 2 to 4 days in the direction of the cross. Again, if you want a copy of my layout and you follow the Thinkorswim platform, if you're over at Schwab and you have that, you could have this layout exactly as you see it right here. Thank you for that, Peter. I really appreciate that. That's very nice of you. I do. I have a passion for teaching people. And I want to help David too. David has a great thing going here. You're getting an education. You're getting a variety of speakers. You don't have to do everything that everyone is doing. You pick and choose what's more to your style. You pick what you like and you go with that, because if you're trying to do someone else's style, if you're trying to trade like someone else, then you're not trading authentically to yourself. Go with what you feel most comfortable. If that's all you're going to trade is buying and selling based on the zero line crossing on the CCI, then there's a great plan, right? There's a great plan. You copy that plan and incorporate the 1% rule into that plan, and you got a formula. Then you could branch out on that. One more stock. I want to show you the crossing of the momentum here. One more stock real quick in the chat. Let's see. I know there's that delay. That's so annoying because if I stop talking right now, you got that dead air, right? I'm sure. PLTR. All right, PLTR. I call this the government stock, right? I'm going to put PLTR in here. I should say the taxpayer stock. PLTR. Look what's happening. Now look at this. I have an upside target on this one. Now I do a rapid fire stock analysis session on Wednesdays. Last night I went through 60 stocks in 60 minutes doing just what I'm doing now, right here. All right, so the indicators down below, that's coming from, it looks like Dale or Dolly. This is the stochastic. You could study that, just do any YouTube video to explain how the stochastic works, and the CCI. The CCI, basically, both of these are overbought, oversold indicators. When the stochastic is below the 20 level, which is that black line, it's oversold. When the CCI is down below 100, that green line, that too is oversold. However, what's happening with the CCI, and you can see why this one's a little bit more sensitive and why I like this one better, is look back here. From the beginning of May, it started going down, and then what happened? It changed angle. That's a shift in the momentum. So the CCI is sensing that there's a shift in the downward momentum. Now, I put an upside target on this one because I believe that the technical indicators are showing more bullish than bearish. Plus, there's a huge gap above here. So my upside target on that is 23.25. So if I buy it at 21, well, let's say I bought it today at 21, and I want to put a $2 risk per share, you might say, oh, it's too wide. That's almost 10% of the stock. Why do you want to go that wide? I want to sleep. I want to sleep at night. I don't want to stress. I'm giving the room that the stock might need to move even against me, but I'm managing my risk. So if I'm putting a stop loss of $2 and I divide that into $1,000, which is my risk per share, I get to buy 500 shares of the stock. If I get stopped out, I just lose 1%, move on to the next trade, done. But this is a high probability trade. Now, if this is being recorded, which I think it is, for those people listening out in the future to the recording, today's date is May 9th. Go back to this date, and I'm challenging you to see whether or not my target hits. I think there's a high probability it will. And there's my evidence. 83% of the time, those targets hit. Now, I got to get back on track because look at this. We're already 20 minutes into this presentation. So we got step one. We got step two. What are we going to do after that? We go to step three, which is the calculation that I just told you. You divide your risk amount by the risk per share, and that's called sizing the position. A lot of you look at your accounts and make the biggest mistake you possibly can make. You look at your buying power, and then you look at the price of the stock, and you look at your buying power again. You start to shift in your seat, and you start to take your calculator out and say, okay, with the buying power I have, how many shares can I buy of this $21 stock? And then you exhaust all your buying power. And then what? And then if it goes against you, you've blown all your buying power. You don't have enough for the next trade. You see that? So that is why sizing the position is a good idea, because remember, with this whole theme of what we're doing here is about emotions, right? You want to relieve yourself of the stress and the pressure, because that pressure, that stress is going to cause you to make very bad decisions. When you're making decisions in a stressful condition, you're going to make very poor decisions. If you take the stress away using simple formula like this, you could relax. You could breathe. You could go have a life. You could go play lacrosse if you're a lacrosse player. You could go have fun with the grandkids if you're a grandparent. You don't have to sit there and stare at your computer all day, right? You can have a life. All right, so that's step three. Remember, I'm just recapping all this. Step one is you go in and you calculate the risk amount. Step two, what do? You calculate the risk per share, which is the stop, between the difference between the stop and your buy price. Step three, you divide the risk per share into the risk amount, and that gets you the proper size of the position. Now I'm going to show you some hammer patterns. I'm going to show you very, very quickly. I'm going to show you some candle patterns that you could use, and I call these my high probability candle patterns. Whether you looked at a candle chart or not, then let this be the first day of the rest of your life. Go on YouTube, follow my market reports. They're free. Just look for Sticky Trades channel, right? Look for stickytrades.com. And every Friday I put out a weekly market report that I've been doing now for Oh, geez, probably 17 years. Every week I put out a market report. So it's all documented. So you'll see with your own eyes how my targets hit. Now, yesterday I put out one midweek report, and I still think we're going to go lower in the near term. And what happened? Oh, bad news came out and the market rallied. Well, that's the way it goes these days. But I'm still keeping my downside targets because my charts are telling me there's still more bearish signals than bullish signals, longer term, intermediate term especially. So I'm going to stick with that and adjust my positions accordingly. But you know what? If the targets don't hit to the downside, but instead go up, I got my risk management plan in place so I don't have to stress out. You saw? You see? So this is a hammer candle right here. It's basically what it looks like. I mean, the Japanese rice traders called it like they saw it. This little body, which is that rectangle, almost looks like a wooden block, right, with a handle on it. So there's your hammer, okay? It doesn't matter what color that is, by the way. If you see this candle at the end of a downward leg or a series of down candles, this becomes an 80% probability that it will go up. 80%. Okay. Now I want to challenge you again. Give me another ticker symbol, and I'm gonna go right to the chart and show you this live. I mean, it's kind of boring if you're just looking at my PowerPoint all afternoon, right? But give me another ticker symbol. Come on, 3, 2, 1. Who's got the next one in there? Microsoft. David, are you the only one that has 2 fingers to type? I don't know. You're like hitting all of them. All right, let's go look at Microsoft. My goal here is to look for hammers. Where are the hammers? Oh, I see a couple. Look at this. There's a hammer right there. See it? Boom. See the hammer? Let me go back to my example. Boom, there's the hammer. Let me go back again to the live chart. There it is. What's happening? Here's a hammer candle at the end of a downward leg. What happened the day after the hammer? Boom, it popped up big time. You would have made a lot of money trading on that hammer. Now get ready because I'm going to ask you for some more stock symbols here in a minute. All right. So there's the hammer. Burn that into your memory and you'll be absolutely fine. I'm trying to find my control button there. There we go. Now, the opposite of a hammer is not called an inverted hammer. This is found at the end of an upward leg. It's called a shooting star. It looks a lot like a hammer turned on its head. Again, the color does not matter. But what does matter is that I lost my control here. I'll have to forgive me. I'm looking for my drawing pen here. What does matter is that the pattern is at the end of an upward leg. So think of this as you're looking for long shadows, those long vertical lines above the candle. That is 80% bearish. So LXTAT. Well, let me go with Ann first because she came in before, and then I got Apple as well. So we'll look at some of these. I'm looking for a shooting star on NVIDIA. Ready? NVDA. I got to type in the right symbol, right, to get that chart to come up. Oh, what do we see? Any shooting stars? Oh, yeah, look at this. See, this isn't a magic trick, folks. These are your ticker symbols. There's your shooting star. There it is. At the end of an upward leg. What happened the day after the shooting star showed up? It dropped. Now there's another candle on there that I'm going to be pointing out in my next slide. And that's that one. See that big red candle? That's engulfing or even eclipsing the previous green candle. That's a bearish candle known as a bearish engulfing, right? I'm going to show you that right here. Let's see. The engulfing. Oh boy, you couldn't pick a better time for that. Here's the bullish engulfing. I know I'm going quickly, but if you have to listen to the recording, you could play it in slow time to catch up, okay? Here we have a big green candle engulfing a red candle. That's bullish 80% of the time. Bearish is just the opposite. Big red eating up or engulfing the previous green. Flipping back to NVIDIA again. There it is. There it is. Oh, and look at that. Look at this one right here. Look at that bearish engulfing candle. Look at that one. What happened? Stock went lower. Let me move a little bit more to the right. Oh, look at that. There's another bearish engulfing candle. See it? Big red engulfing the previous green. What happened? Stock dropped. Here, big red engulfing the previous green. What happened? Stock dropped. Now, I'm not going to get into this, but this is also a bearish harami. You could study that on your own. Bearish harami and bearish engulfings are pretty much the same. They're related, but they are both as bearish when they show up on a chart. Right, now I'm going to go a little bit faster to get some more examples. These are variations of bearish engulfing. Why am I showing you so many charts? Because the charts, remember, don't have emotion. If you get too tied up in the financial programs and too tied up in the fundamental reports and all the articles that are about these stocks, you're forcing yourself to get emotionally tied to the stock. If you focus on the charts, you're not getting emotionally involved in anything because the charts don't have an emotion. It's simply a historic record of price pattern. That's all it is. And you're following the buying pressure and the selling pressure because you're putting your money in the direction of where the money is going. Folks, are you having a good time? I can't see you, can't hear you. I don't know if you're raising your hand. I don't know if you're clapping, but I'm just hoping you're having a good time because I am. I really am. All right, so next one, spinning top. It's a very small body candle, just very small. Again, the Japanese call this like they saw it. It looks like a little dreidel, if you will, a little child's top that you spin on a desktop or a table. That's all it is. It's a small body candle that is showing vertical lines or what they call shadows above and below that are almost equidistant to the middle. Now, I'm going to go through the spinning top to show you how they show up. Again, the color does not matter. A spinning top, like a doji, which is going to be on my next slide, are signs of indecision. See, the Japanese, when they came up with the system of charting, they didn't look at it in so much as the price action. These candles for the Japanese displayed the emotions or the mindset of the other traders who were trading the same commodity. So if they could read the emotions or read the ideas or mindset, they could more or less forecast what would happen. Because the candles will also tell you when fear is creeping into the market. Got big red long candles. That's fearful movement in the market. And when the candles get smaller and the volume starts drifting, fear starts to dissipate, and that's when you start to step in and buy after the sellers have completely panicked and sold out. You see, so if you're reading the candles, it's helping you with the timing. So these spinning tops are found usually at pivot points. The same thing for dojis. They're very similar and very much related to spinning tops, except they don't have a body. The opening and the close are exactly the same. They look like little crosses. I'm sure we'll find these for sure. So these crosses are also signs of indecision. They show up at pivot points just before and maybe even a little after a pivot point is formed, and they are also high probability turnaround points. They're not exactly where I would be taking action on a stock, but it is a warning flag where the charts are telling you, get ready, something is about to happen. See, here's just some examples of what I'm talking about. Look, bearish engulfing right there, right? We have a shooting star right there, bearish. Hammer, bullish. See that? Bullish engulfing. Look at that. Bullish engulfing. Beautiful. Look at this hammer. There's a hammer right at the end of the bottom. It did pivot already, but the hammer came very close or within close proximity of that exact low. You see that? And so when you look at that, you'll be able to find them on the chart. So let me pick up where I left off. We had David's Microsoft. Let's go look at Stoya's Apple, AAPL. Let's go take a look at that one. Again, I'm going to look for spinning tops now, and I'm looking for dojis, all right? AAPL, spinning tops and dojis. Where's the spinning top? Oh, look at that. Spinning top right at the bottom, right here. Look at that. See that spinning top? There's a spinning top. There's a spinning top, pretty close to one right there at a high. Here's a spinning top. Look at that. It's one day off the exact high back there. Where are the dojis? Can anyone see them? This is a live chart, by the way, of Apple. Can anyone see the dojis? They're very hard to see. There's a doji right there. See it? There's a doji right there. See, the stock had been heading down, and then the doji shows up. Well, that's a sign of indecision. Chart's telling you, get ready, it's about to reverse. Well, 4 days later, it did reverse. It went higher. Here's a doji that's also very closely resembles a shooting star. That showed up exactly at the high before it dropped. You see that? Here's another doji. Follows, it's 1 day before the exact high. You see how nice that is? So when you start relying more on your ability to read the charts and less and putting less emphasis on relying on someone else to tell you what to do, then you'll be fine. You'll just start making these decisions on your own. Now, Apple, we did Nvidia, LXTAT, LX Tate. Let's go to Tesla, TSLA. Now, I have a downside target on Tesla. I have a downside target already on Tesla. And I'm keeping that downside target in Tesla. Can anyone who knows anything about charts tell me why I'm still bearish on Tesla in the chat box? Can anyone? I know that I already pointed it out in another stock, but I just want to see how many of you already found it. Open gap below the market. Yeah, by the way, I didn't mention that, but gaps act as price magnets. 80% of the time, these gaps fill. See, this gap, it gapped up. Well, guess what? Yesterday, it filled. See, 80% of the time, gaps fill. Now, there's still a gap below the market here, and there's a little bit of a gap here. So right now, Tesla is caught between two gaps. The main reason why I think it's going down, and Dennis, you are right, it is showing lower highs overall, but my main reason, and I gave you the 3 letters and why this is my favorite, look at the CCI. It's a hair, literally a hair away from crossing below the momentum line. When was the last time it crossed below the momentum line? Crossed below now. The last time it crossed below the momentum line was right after that spinning top. And look what happened. Bam, it got smacked, right? Again, the charts are right the majority of the time. But why do we have a 1% rule? Because we have to plan for the times when we're going to be wrong 17 to 20% of the time. You can't be fooling yourself thinking that, oh, I'm just going to hold on until I'm right. It's not going to work for you. If anything, position trade, if you're holding on to position that's losing money, trade other stocks that are making money. Let me just show you one. I wasn't going to do this, but I have to because it's just so good. Let me show you. We have our members in this stock. Some of you know of it already. It used to be Digital World Acquisition. They changed the ticker symbol to DJT. We put this on. Now, this is a bearish position, by the way. We put this on in January. Let me just show you what this looked like in January. All right, so this is DJT. Back then, it was in DWAC ticker symbol. In January, back here, we put on the put spread right here as it was starting to go down, right? Because we read the charts. Now, this is a little bit more sophisticated of a position, but you have to understand something. Since January 23rd, we've been selling options each month to collect net credits. And we've collected so many credits that now the option that we bought at 36, we have a cost basis now of $8, roughly $8. And tonight I'm putting out a trade publication for you members that are on from Sticky Trades that are listening to this. You're going to get a trade publication tonight that's going to help you get another $8 in the bank. And guess what? This whole spread is going to cost you $0. And for the next year and a half, you're going to have a risk-free trade that's going to turn into a cash cow. How about that? That's for our members right there. And it's not too late to put that trade on, by the way. See, a put spread like this could still make money on the way up. I mean, if it's already paid off entirely to $0, it doesn't matter which way the markets are going to go. I'm still going to collect credits by rolling. I know that was a more sophisticated strategy, but this is what we do. This is what we do here. All right, I got to calm down because I get really excited about this because you know what? If you're brand new to charts, then you're absolutely going to be brand new to options. Take it one step at a time. Learn how to do this. Get excited about it. And then once you learn it, start teaching it to other people. Start teaching it to others that they can learn how to do it and how to read charts. They don't teach it in high school. They don't teach it in colleges. Many parents don't teach it at home. I think my son is on here with us. AJ Anthony are you on here? Shout out on the chat. Oh, he's the Patriot Lax. Okay, yeah. He watched me as a little boy. I mean, a little kid. No kidding. Yeah, 5 years old. He's watching me look at the charts. He knows what I'm talking about here, and it does take time. It takes time to learn this. But again, it's like anything. Every journey starts with one first step, and we're here to help you. By the way, that's what we hear at Sticky Trades. And I want to talk to David more about how to expand out and help a bigger audience. Because like I said, if we could help everyone make money and you get all the bills paid off, then you won't have to worry. Because the markets are going to be around long after we're gone from planet Earth. It's still going to be trudging away. If you can master the art of technical analysis and keeping it all super simple, then the market becomes an income generating tool for you. And if you do it without getting stressed out, then you could absolutely relax with it. Now, real quickly, I want to show you my 7-point trading checklist. Let me see if I can expand this a little bit. All right, if we have any questions coming up, I don't know where the Q&A box is, but if we have any questions in there, start pumping them in. You can even put them in the chat box. I don't care. I'll find them on the chat box. And this is my 7-point trading checklist. Remember what I just showed you on the candle patterns. I showed you bullish and bearish patterns. I talked a little bit about the bearish harami that's like an engulfing. I talked about the hammer. I talked about the shooting star. I didn't talk about these, but those are easy to learn. And I didn't talk about a stale green light. What's a stale green light or a stale red light? That's when you have a long stretch of green and you're waiting for it to turn red. Yeah. Or if you have a stock that's going up and you see nothing but green, 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 it's getting ready to go red, and then all of a sudden you look at your charts and you go, oh, there's no way I'm buying that, baby. That's too much green. It's about to turn red and I'm going to get hurt. Here's an example. For those of you that are trading this, I think this is absolutely insane. First and foremost, look at the bearish engulfing candle on NVIDIA today. You see this? I was talking with one of our VIP members and we put on a trade in NVIDIA, a bearish position in NVIDIA. See that? That's why. Now, that bearish engulfing candle I just showed you in the textbook formula there has worked very well for NVIDIA. Look, bearish engulfing. What happened? It went down. Look, bearish harami. That's like a bearish engulfing. What happened? It went down. Bearish engulfing. There is another one. What happened? It went down. Oh, bullish harami. Oh, look at that. That went up because that's a bullish signal. Now we got a bearish harami followed by a bearish engulfing. You don't need a computer to figure this out. You just got to memorize the look of it and understand some basic concepts of charting. Now, if that's all you know, that a bearish engulfing is bearish, then maybe you'll talk yourself out of buying it on a day like today because you could get hurt, right? So that's NVIDIA. But look at this thing on the monthly chart. This is what flips me out. Look at this thing. Now, I'm not going to get too far into fan lines, but I will tell you there are 8 fan lines here. You very rarely, if ever, find an accelerated trend. That's what a fan line is. An accelerated trend that eventually winds up with 8 and more vertical trends each and every time. This is the 8th fan line that is now broken on the monthly chart. The 8th fan line has broken. So now my forecast on NVIDIA is going to be down here right around 750. This stock could easily drop $130 from here. Now, if you don't have a whole lot of money in your account, but you start to learn options and how to put on very simple debit put spreads, for instance, all right, this is recorded, so you can go back and review what I'm saying here so you don't have to waste any time. Bearish put spreads, you could buy very cheap bearish put spreads, debit put spreads, and make money all the way down as NVIDIA continues to go lower. You see that? So this is what I do. It's not rocket science, but it will take some time to learn. And once you get through the trading checklist, you'll also understand how volume plays into the equation. See, if a stock is going up, watch this. If a stock, let's say these are all candles. if the stock is going up, but the volume is consistently dropping while the price is going up, that's telling us that the buyers are running out of buying power. So you're getting very close to a top. Then you start to see bearish engulfing, hanging men, shooting stars, bearish haramis. You start to see those show up. And then, boom, I'm going to react to the chart. I could take action. And then as soon as you do that, you set your stops so you could use the 1% rule. Another thing that I have on the trading checklist that could take, maybe a half hour to explain in its entirety are divergences from the 20-day moving average. I use the 20-day moving average. Why? Because John Bollinger uses the 20-day moving average. Why else? Because Jim Rohrbach uses the 20-period moving average. I had a PBS show on WXEL called Wealth and Wisdom, and I had Jim Rohrbach as my main guest for that segment. And Jim at the time was known as the Zen of market timers. He was the #1 stock picker in the world at that time. And I said, Jim, tell me your secret. And he did. He said, I use the 20-period moving average as a guide. If a stock crosses below the 20-period moving average, I'll sell it. If it goes above the moving average, I'll buy it. And John Bollinger took that concept and started looking at divergences from the moving average. So you could think it's the moving average as fair value for the stock. Who has another ticker symbol? All right, Dennis has Google. All right, let's go look at Google. And I'll try to look at the moving average as we're looking at GOOG. GOOG. There we go. Look at that. This is a monthly chart now, monthly, but look at how far the price is from that moving average. Last time it was that far away from the moving average. What happened? The stock got crushed. This is a monthly chart now. That's a 20-month moving average. But now if I go and I look at the daily chart, I got to go to a 1-year daily here. You could see, again, look at how far the moving average, how far the stock was from the moving average. Let me get there's a little camera. Yeah, I got to get that out of the way. Look at how far the stock moved away from the moving average right here. And look what's happening. It's snapping back. I think Google is another one that could start pulling back. Why? Look at the spinning top right there. The sign of indecision. Look how the stock has been going up, but the volume is going down. I just explained that to you, right? Hopefully you got that. When the price is going up, the volume is going down, it's a sign of weakness. All right, let's go VST. Who is that? Peter? Hey, Peter, thank you so much. All right, let's look at VST. Oh, man, sell it. Sell it, sell it. On the net, I would sell half of my position. I would scale in with a 50% short position on this one because of the severe drop in volume, the wide divergence from the moving average, and you've got it looks to be maybe a gap down below the market, way down here though. That's way down there. But I would take 50% short position, and then when I get a pivot or a bearish candle, I would lay into the rest of it. Where would I get out? Right there, right at the moving average. Why? Because that's former resistance, broken, turns to support. Most likely the stock is going to bounce off of that level if it gets down there. Peter, do you have a position in this one, by the way? Just put a Y or an N in there if you do or don't. I don't know. Yeah, because this one, I don't even know if this one has options. If it does, I might even put this one out. Ooh, look at that. It's got some nice options on there. I would go into a debit put spread. Let me just throw this out there to the option traders. Let's go look at the 105 100 vertical put spread. Can I buy a $5 bill? Oh, look at that. You could buy a $5 spread for $4.35. So if it stays below 100, which chances are it will, if it stays below 100, you're going to make 63 cents on a $4.35 investment. See, for you people that don't have a whole lot of money, it's only going to cost you $435 for that option, right? And the most you could lose, if you're wrong, is $435. So you got calculated risk already built into that spread. So Peter, you sold out of it today. All right, I like that idea. All right, I'm going to take one more stock, and we're going to bring it all together. I'm going to look at bearish engulfing, bullish engulfing, EDU. Let's take a look at that one. Who is that one? Is it Dalji? I'm sorry if I'm mispronouncing it. Some people just use code names. Oh, DJ. Okay, that's better. Much better. EDU. What do we got? Oh, look at that. There's a big nothing burger. It's not doing anything. It's right on the moving average. Look at that. The oscillators are kind of stuck in the middle. It already crossed above. See, it already crossed above the momentum line on Tuesday. So remember what I said, once the momentum line crosses, you got 2 to 4 days. We're already 3 days into it. So I wouldn't take any action on that. But if you have it, the good news for you, if you own it, is that there's a gap up here that will most likely act as a price magnet. Remember, 80% of the time, those gaps fill, right? Look, here was a gap. What happened? It filled. Here was a gap. Oh, what happened? It filled. You see, here's a gap, even all the way down here, a small gap, that filled on the same day as the upper gap filled. So here's a little gap that filled. So there is a good chance it can rally back up to around 88, maybe 89, at which time you're going to keep an eye on the signals, stick to your plan, and make sure that you are not getting emotionally involved in this market. One last thing, I want to give you the email again so that you have it ready when you need it. It's ajmembers@stickytrades.com. ajmembers@stickytrades.com. There it is. So if you have any questions, I can't give you advice on money management or anything like that, but if you have questions, send it on over to Sticky Trades. If you want my layout, send it on over to Sticky Trades. If you want a copy of the PowerPoint, send it on over. If you want to become a member, we have a 15-day trial. You could try for free, absolutely free. If you want to catch me on YouTube, look me up on YouTube. I'm not hard to find. And most importantly, this is it. I'm going to slow it down just a little bit because I'm so serious about this one. If you are that type of person that wants to give out and change the world for the better, we want to definitely be talking to you. We definitely want to be helping you. Please let us know that you're that person, and we're going to go out there and help. And that we have a lot of people in our membership who would even love to help out in that cause, like Roby. Remember what I said? Roby is one of those angels that I say living on earth, who is giving back to those kids that are in St. Jude's, using money. Think about this, using money from the market. Think about all the greed that's on Wall Street, all the bankers, the money managers, the hedge fund managers, making money, money, money. What are they doing? They're just making more profits for their companies and for their funds. And yeah, of course, for their investors. But there's a special group up there that's looking at the market saying, I'm going to make some money, but I'm going to do good things with it. Yes, take care of your family. Take care of your kids, your grandkids, take care of your needs, get debt free, get all that. And then when you're done and you're comfortable, boom, come on over and let's go change the world one person at a time. I am wrapped up. It's 5:50 on the nose. David, you could take it from me. I'm going to hop on to my next webinar with our members. Thank you so much, folks. I really had a great time. I hope you did. I hope you did too. All right, David, take it away.